the interest rates are unlikely to move up substantially over the next 2 years. I mean, I can put my neck out there and say probably for quite a while, but I think with reasonable confidence, I can say at least for the next 2 years, they are unlikely to move up substantially.
If you really invest and get it within 4 years, minimum you should get at 60% or 70% or 80%. So like that 3 cycles mean or 200%, and you can leverage also. Then it can be 3-4. But if you really do it within 10-15 years, you can have not only one apartment, you can have portfolio of apartments.
I think unit trust has this ability to give an ordinary investor exposure to both fixed income and equities with professional expertise.
Then it is tourist real estate model is very popular, and it gives you very much rental yields.
Hello and welcome back to Point of View by CA Sri Lanka. I'm your host Oshadha de Vas Gunasekara, and we look to explore today about the new investment opportunities available in the current low interest rate environment. And to discuss this, we have two eminent guests on the program today, Mr. Premalal Brahmanage, Group Chairman of the Prime Group, and Mr. Asanka Herath, Head of Equities at LYNEAR Wealth Management. Welcome, both of you. And so without much ado, let us start off the conversation. To kind of set the stage, let me invite Mr. Asanka. So looking at the macro plus the global uncertainties we have been seeing over the last few months with Trump coming into power in the US. Looking at the local perspective, the Sri Lankan economy has been in quite a stable footing. We've recovered from the crisis. Last year, GDP growth was about 5%. Inflation is very much under control. And then the interest rates are quite low. Looking at the global angle, we have reciprocal tariffs probably coming in. So with this, there's a lot of uncertainty. And uncertainty isn't exactly great for markets. But then again, Sri Lanka's low interest rate environment means that a lot of people are now yielding very low returns on whatever the assets they hold. And typically, most of Sri Lankans' assets are in traditional investments like fixed deposits or government treasuries. So in that context, could you kind of set the stage for us on kind of what are the instruments they can look at over the next few years in terms of whether it's capital markets, in terms of equities or corporate bonds, or in terms of real estate, or even from a global perspective, we've seen recently there are a lot of the investors have been risk off and they are moving into safe haven assets like gold. So if you can give some perspective on that.
Thanks, Oshadha. I think let me just start off by giving a view on the Sri Lankan economy, because that to a large extent will dictate as to what are the instruments that Sri Lankan investors should invest in. I think we are probably into an economic regime which Sri Lanka has not seen for quite a long time. And I think that's something that the wider population is yet to really understand. Now, legally, it is not possible for the central bank, for all practical purposes, to print money to fund the budget deficit. And the first time in a long time, maybe 30, 40 years or it could be longer, the treasury has a positive cash balance. And even if you look at next year, and we actually think this year, and we actually think even looking to next year, the government is likely to run a primary surplus. So in literally what it's going to mean is the government is going to require less funding, less borrowing from the domestic banking system and other investors for their day-to-day operation. That wasn't the case for large part of, I would say, close to 40-50 years. And it's because you had this extra borrower in the form of the government, which led to higher interest rates. And with that risk not likely to materialize again for quite a while, rates are likely to remain low. Also, the Sri Lankan government and actually central bank has committed to maintain a moderate level of inflation. That also means the central bank is very much likely to step in the moment they feel the private credit growth is going beyond a certain level. Also, central bank has a very close eye on the external situation. So the moment they feel the import demand is likely going to be excessive, they will take measures to cool the economy. So all of that means even the demand for private credit will be managed at a sustainable level. So both of those means the interest rates are unlikely to move up substantially over the next 2 years. I mean, I can put my neck out there and say probably for quite a while, but I think with reasonable confidence, I can say at least for the next 2 years, they are unlikely to move up substantially. Towards the end of the year, maybe the rates can move up by about 100 basis points. So what does that mean for an investor? I mean, what it means for an investor is your 1 year or 2 year deposit rates will be around 10% or less than that. And with the level of taxation, you will only be taking home about 6.5 to 7.5%. Government is committed to a moderate level of inflation of about 6%. So if you just take home about 6 to 7% interest rate every year, and anyway the price levels are going to grow at about 5 to 6%, your wealth is never really going to grow. So that's a key thing investors won't realize in terms of domestic, from a domestic angle. So I think, to speak in very general terms, across the investing population in Sri Lanka, I feel the asset allocation is currently not correct. There's way too much exposure to current and savings deposits in the banking and the non-banking system. There's way too much money in money market funds. And if the investors are keen on growing their wealth in real terms, they will have to look at depending on the level of risk, and allocation to equities and real estate. An advantage in real estate is the fact that lending rates are going to be lower and you can leverage and invest. I do believe that private equity is also an asset class which will flourish in a recovering economy, but for a larger segment of the population, you don't have access to private equity. So that is my take on investing from a domestic angle. If you factor in the global environment, I think we all have to realize what we consider as normal is based on our own living memory. Today is 2025, average lifespan is about 75 years. So actually what we consider normal are things which has happened from about 1950s onwards. I think the global regimes are changing, and that changes means the global level of volatility will be higher. And that's what you are seeing in increase in the gold prices. Gold is always seen as a safe haven in a crisis. And gold is a commodity with a finite supply. So in most scenarios, it has always been a great idea to have an allocation to gold, either as an individual investor or even as a company. And I think that allocation may have to be higher given the global volatility. As to the impact of what Trump tariffs will mean on Sri Lanka, we'll have to wait and see. So on the from a local investor perspective, I think they had to rethink the asset allocation and move away from traditional fixed income instrument. From a global perspective, it's always a good idea to have an exposure to gold. And given the global volatility, we have to be ready both as a country and at business level as to what these changing economic regimes in the world means.
Thanks, Mr. Asanka. Mr. Premalal, if I can bring you in here. So now, since Asanka mentioned real estate investments also, Mr. Premalal, this is what you have been doing for a very long time. You're kind of a veteran in the industry. So what have you seen over the last few years with the interest rates coming down? Essentially, since about the beginning of 2024, we've had quite a low interest rate regime. Have you seen the demand pick up in the local real estate market? And what have you seen in terms of the industry, in terms of the mix of buyers? Are they more homeowners or are they now kind of in the investment side as well?
Yeah, when it comes to last 2 years or 2.5 years, of course, the real estate market is growing. Of course, we had a decline after the Easter bomb and the financial crisis. And then latter part, last 2 years, we were picking up. And then at the moment, I would say real estate is really doing great, in the sense that whatever in our case, the projects that we launch are picked up with a lot of interest. And anyway, real estate is going to be the growing in Sri Lanka. Temporarily, we had that setback because we are an island and the land is limited, and even the ratio for housing is limited, so that the younger population is there and the demand is there. So real estate as a whole is always is better when you look at as an investment asset also, is really a good thing. Against financial asset, real estate is a tangible asset, so that you can touch, feel, and you can rent, and all that are there. So always when we look at our parents, grandparents, great grandparents, they were relying on real estate. You don't have to have a very much thorough learning about the entire financial market. With a common sense, you can really invest in real estate. And now the trend is now ratio to apartments to houses are in Sri Lanka very low. So that there's a big demand for apartments. A lot of youngsters are moving to the apartment. So as a result, as apartment demand also is there, and also gated community, unlike here and there standalone houses, people would like to move into that. With the advantages are the security, then all the common amenities, and all the other infrastructure. With some are coming with very beautiful concepts, so that people would like to love to go there. As a result, demand is there, and what I see is and the demand for real estate now coming to the established developers. Because last time people have burned their fingers with going into unknown developers, and as a result, we see for known brands, people are coming for a lot of demand for the known brands. Then your question is, as Asanka said, now it's really a good investment vehicle, real estate, always, because it's, especially in Sri Lanka, it's always going up. I mean, if you take lands, if you take houses or apartments, all are appreciating. And our products, of course, appreciating at least annually 20% like that. But even average, I think 15% is a average appreciation for a quality house or apartment. Now against here 5%, 6% net situation, real estate is a good investment as well. And it is the asset that you can leverage. Now, for example, when you are buying 30 million apartment or whatever, you don't pay 30 million immediately. You pay a fraction of 30% or 40%, and then you pay over the period. But the appreciation of the asset is on the whole. On the 30 million, it is appreciating, but you are paying a lesser amount, so that your rate of appreciation is high. The capital gains are high. So as a result, a lot of our, when you talk of our customers, they had a massive capital gains. All of our apartments, some are having over 100%, 120%, like that. For example, brand, some people who have bought it at 48, they are selling at 120 million. So like that, appreciation is very high. So that, if you really analyze and go into a correct developer, then your risk also substantially lower. So the rate of return is very high. So then also there's another set of people, they want a house or apartment. So that demand comes from them as well. So to your question, who are the proportionately, I think 50-50. 50% is investors and 50% are other end users. That's how it goes.
And then within the investors, what is the mix like? How many are Sri Lankans? How many expats? And do you even have like foreign nationals who are buying?
Yeah, normally it's like 10% is like foreigners, 5 to 10%. Investors, local, the 30% is expatriates, and then another 60% is local. That's how local investors and the end users both.
Okay, Mr. Premalal. So, just to get an idea, real estate generally is known as kind of a long-term asset class. What would you say if you look at maybe a 10-year horizon? What would you say is like a possible level of capital gain, and then what kind of rental yields are you kind of looking at in a more typical urban kind of an area?
Yeah, now if you take a good project, the project is supposed to be completed within a matter of 4 years, so that you can leverage it, and you can have within 10 years like 3 cycles. Then your rate of return can be very high. I do not know. It may be if you really invest and get it within 4 years, minimum you should get at 60% or 70% or 80%. So like that 3 cycles mean or 200%, and you can leverage also. Then it can be 3-4. But if you really do it within 10-15 years, you can have not only one apartment, you can have portfolio of apartments like 10-15. Now India and all that, young professionals and all that, they really do it really well, and their plan is to within next 15 years I will have 15 apartments, and then they run it as a hotel, like they have Airbnb and several different places, and they can have a massive passive income. Now especially for professionals like chartered accountant, now we are in this forum, they can really plan it, and this is a amazing leveraging asset where you say you are paying, we have of course introduced 10%, but let's say even average in 25%. So by paying 25% in advance, you are buying a 100% asset. So it grows, no, it has a normal annual as the building is come up. So it's appreciated. Once it's completed, appreciation is very high.
Thank you, Mr. Prema. Mr. Asanka, if I may come back to you. So, let's say someone who doesn't have much expertise in investing in the capital markets, a good kind of investment vehicle is the unit trusts for them to get into the market. Now, unit trusts, mutual funds, these have actually been very popular across the world. Even in the region in India, they have gained a lot of traction. But for some reason in Sri Lanka, the traction this market has received is quite small. Could you kind of give some perspective on the unit trusts and what kind of opportunities it presents, and why people should actually look at this as an investment vehicle?
I think why people should look at unit trust and opportunity present is essentially the same thing. I think unit trust has this ability to give an ordinary investor exposure to both fixed income and equities with professional expertise. Right. Now, if you take a fixed income, if you take an ordinary investor who goes and put money in the bank or a finance company or buy a treasury bill or a bond or a corporate debenture, there are few things he has to do by himself. First thing he needs to figure out, given the interest rate cycle, are the rates likely to go up? Should I actually invest at this rate, or should I wait a few months, or should I wait a year and invest at a higher rate? Or will the rates go down, so actually I should take this rate? Should I invest at a fixed rate or not? So that call, that if an investor is going to do it on its own, he has to make that call. And the movement of the interest rates depend on a lot of economic variables, which requires actually professional attention. Now, most of our investors are actually used to asking their respective bank manager, But I mean, there are trusted bank managers are trusted and they do a great service. But I think we all have to realize the bankers essentially, they have to lend the money they take from the depositors. And the banks make money on the difference between the rate they pay the depositors and rate at which they lend. So actually, there's almost a conflict of interest for a branch manager when ordinary investor goes and asks, is the good rate for the invest? Because at the end of the day, for him, he has to keep his cost of funds lower for the bank to make money. Right? So that entire issue of lack of specialist knowledge, avoiding the conflict of interest by seeking advice from bankers as whether they are investing at the correct rate of interest, all that issue goes away when you invest with a unit trust, fixed income unit trust. So it's regulated by Securities and Exchange Commission, and you have professional fund managers who as a profession study the interest rate cycle to understand, is this the correct time to invest short or is the correct time to actually lock in and invest in the long term. So you get that professional attention. Secondly, unit trust also give you the access to invest in listed equities. Many of the investors actually do invest in listed equities, but unless you are a very large equity investor, you will not get to see the deeper understanding of the fund flows into the market. You will also lack that ability to understand the company's performance. Now, with a fund, when you invest in a unit trust through a fund manager, that fund manager has that specialist knowledge to execute that. I actually started investing in the market at the age of 18. Before I took a driving license, I actually opened a CDS account. And I started off by investing 60,000 rupees. My first brokerage account was a CTC LSA. But just to give that example as a way to why the investors need that specialist knowledge. So when you walked into CTC LSA as an 18-year-old, nobody pays attention to you, and you actually do not have that understanding, right? But now as a fund manager, when you look at it, you see how much more specialist knowledge you have. So the investor who comes with a fund manager will benefit from that specialist knowledge. Now, if you look at the last 3 to 4 years, equity markets have been very volatile. They have been at times that you have had investors who've been extremely happy about the returns they have made. But most of them in the downturn didn't have the discipline to sell and lost all of it. So you also get the discipline of investing with a fund manager if you come through the unit trust. I think another factor that you need to consider is the general belief is unrealized gains in unit trusts are not taxed. So anyway, the unit trust which carries equities do not attract taxation. The unit trust which carries fixed income do attract taxation, but you only actually pay taxes when you withdraw and on the income you made on the portion that you withdraw. You can defer your taxation over a period of time. So even if the tax rates remain at a higher level over a period of time, it's still efficient because you get return compounding on your tax which is saved. So having that professional expertise, having access to greater level of information, tax efficiency are 3 key reasons. But before I wrap up my answer, the fourth thing is the documentation. How many of us have time to go to the bank or to give the bank the instruction for a fixed deposit renewal? How many times it has happened where you have forgotten to renew it and it get auto renewed at a lower rate? Now, when you invest in a unit trust, you only have to do documentation that one time. And it's a fund manager who looks after the renewals and the rest of the documentation. And that's one of the key advantages as well.
Thanks, Mr. Asanka. So, Mr. Premalal, if I may ask, since Mr. Asanka brought up the taxation perspective for unit trusts, how are returns on real estate taxed?
Yeah, basically individually it's earlier it was capital gain was 3%, and now it is from yesterday it's 15%. So still it is much lesser than
That's on the capital gain.
on the capital gain. So it's still it's very advantage when it comes to taxation as well.
Okay. Compared to interest rates, where
Yeah.
it's 36%.
36%. So
if
here
you're on the highest
still
rate.
you pay 15%. That's all after deducting everything.
So, if I were to ask both of you, what are kind of the major risks someone should consider when investing? Mr. Premalal, maybe you can start off with the real estate.
Real estate, if you invest properly with common sense, your risk is very low. Now we'll have to understand this. Now let's take an apartment. If you are going to buy an apartment, you go there, you look at the location, you look at the design, you look at the layouts, you decide whether 2-bed or 3-bed, and you still go into the extent of who is the architect and the interior, exterior, price, the discount, payment term, all those things you will look at. So what you are looking at really there, you are looking at the development. It is equal or more important to see the developer also. What is his credibility, how long he has been there, how many projects he has delivered, how many projects, this kind of project he has developed, developed, and the quality of his apartment, his financial capability, all that has to be looked into, because that is where your hard-earned money is going to be invested. So that you are looking at the developer. So looking at the developer is also is more important or equally important like looking at the development. So that is how to mitigate. And also whether the developer, you will have to, Sri Lanka, no, you have to look at the developer's behavior, whether he is using your money and using for a personal thing, and are you going to pay a lot of money in advance before the project has come out. Now some of the developers, they collect 90% of the total apartment cost before the completion, no, at the time by that time of completion, like they collect 30% immediately, then every month, maybe 3 years or 4 years, they are collecting 90%. That means your risk is also high. If he does not deliver, or if he delay the delivery, and even your rate of return also low, no, because you are investing more. You will have to look at that, how much money you are going to put in the first year, second year, third year, like that. The lesser the money you are investing, then your risk is less, and your return are also high. Here the other way, your risk is less and the returns are high. Your risk is less because you have investing a small amount, and the returns, because of the investing small amount, but the returns are on the same level, same apartment, so the returns are high. So this that is a combination that you will have to look into. That is where you will have to see the developer, and at the same time your developer, how much money you are going to put it during the construction period. Lesser you put it, it is better. Your risk is less and the rate of return is high. So these are the factors where you will have to really look into mitigating the risk. But generally, if you use your common sense and do some due diligence and see it, then real estate is a great investment and very much rewarding investment.
Thank you, Mr. Premalal. Mr. Asanka, if you could also add on the risks in the equity market and the unit trusts.
In the risk in the equity market and the unit trust. Okay, I think equity compared with fixed income is a riskier asset class. And I think it boils down to, very generally speaking, two aspects. One is the lack of knowledge or the need for additional knowledge when you invest in equities. You need to have the skill set and the knowledge to understand whether the shares of the company that you are, whether the company, which shares that you are purchasing, right? Does it have a sound balance sheet? Does it have attractive growth prospects? And is the company's share price cheaper than what its actual value is? So you need to have that understanding to reduce the level of equity risk. So I would say lack of knowledge is the key aspect which helps can reduce the equity risk. But second aspect that you need to consider is that depending on the economic cycle, the prospects for companies can vary from time to time. So your equity returns is a function of how the broad economy is performing. So it's not good enough for you to just understand the prospects for the economy. Now, moving on to as to the risks with regard to the unit trust, let me actually answer it by trying to explain what are the things investors should look at when they pick a unit trust or unit trust fund manager to invest in. When it comes to fixed income unit trust or a fixed income fund manager, you need to actually have understanding as to the credit quality of the underlying instruments the fund has invested in. That means what is the credit quality of the finance companies that the fund has put deposits in. Credit quality of the banks they have put in deposits in. Credit quality of companies the fund has lent money to. Has any of those companies struggling in terms of repaying? Are there deposits which are getting renewed without actually getting paid back? Now that has been a concern. So those are the key things to consider. When it comes to equity unit trust, you need to understand, does the fund manager has a philosophy? Is it a more of a growth focused philosophy or more of a value focused philosophy? Does he have the discipline to understand the companies innately before he makes a decision? Does he react to share price movements or does he have the discipline to stick to the fundamentals? It's not, and both when it comes to select to fixed income funds as well as equity funds, it's not just enough to understand all of these at a point in time. You also need to go back into the history of each of the funds to see whether how those aspects have evolved over a period of time, because the behaviors are very difficult to change. So the track record of a fund manager, how he has behaved in the past, matters as much as how he is behaving now. So those are the factors to consider if you in terms of risk when you are selecting unit trust or a fund manager.
Final two questions, Mr. Premalal. If I were to ask you on the real estate industry, if you are to look at maybe the next decade or so, how do you see the industry evolving? So I think some of the developers currently are looking at service departments in the tourist hotspots and all of those. How will that change the landscape, and are the investment prospects in those kind of projects as well as any new kind of innovative projects that can come up that much better than what's on offer right now?
Yeah. Now, for example, service apartment like hotel apartments is a great product that is happening at the moment, and of course, what we have introduced also has been very successful. It's basically where people are very comfortable, because once you buy it, then we can take it, the prospective developer, whoever, can take it back and then it's done for you. Like Airbnb, then we do the housekeeping, we do all the other concierge and all those things. Then we will do the booking in on behalf of you, and then you can see it. How much money, how much booking you have so far, how much money you have received so far, and next month bookings are how much, and all that can be seen. And then especially for expatriates, they are not living here. The apartment will be looked after, the housekeeping will be done, and then it's basically like a hotel. Other than the room service, there will be a restaurant and all that. So it's a great thing that is happening, and it is a solution also. A lot of tourists, they like to come to service apartments, because then much of Their privacy is there, then the room, the size of the apartment is much bigger than just confined to a room, and there are no limitations of the timing of your lunch or dinner and all that, and they can cook by themselves. So it's it's in very much high demand. So then it is tourist real estate model is very popular, and we also as a company are doing about several projects at the moment. So and it gives you very much rental yields by in terms of the rental yield. Some of the projects which we have introduced are going even more than 12%, other than the capital appreciation. So that is going to be next thing in real estate. And also there are a lot of innovativeness can come into the real estate, like new concepts like futuristic project. On the other hand, I would say as a country, we are not doing much about real estate. We can really export real estate. People are now willing to come to Sri Lanka. Even expatriates are now looking at Sri Lanka. At least they want to come here. If they are not coming permanently, at least during the winter season and even some summer season. So we can really export to our expatriates and also to the foreigners. How about India? If we can tap properly Indian market, then these houses are not enough. Even we can build thousands of units, and so that is where the government has to look into and have a proper structures for that, like golden visa system, and still government is not really addressing to that. I hope that they will one day look at, and we are also making some representation and saying about those things. So they will, of course, will do it soon. So if that happens, the real estate market in Sri Lanka is going to be exponential growth, and it can happen, and it is there. And we are a beautiful country, and we are a clean country, and all that are there, no? So when you compare with the other destinations and so on.
Thanks, Mr. Premal. Mr. Asanka, final question, if I may put you on the spot. Given the current context, what would be your ideal asset allocation?
So I think ideal asset allocation boils down a lot to each individual investors, each individual institutional investors' risk appetite. So I would say, no, if I look at most of our, if I look at on the average investors' equity allocation at this point in time can be around 50% or so. But you need to understand, I'm speaking as a very much a professional fund manager who manages very large, very substantial amount of money. But what I encourage each investor is to decide the allocation based on your goals. So very simply, you need to figure out, why do you want to build your wealth for? By when do you need the wealth by? What is the time period to that? How much money do you have? And so what is the rate of return you need to have? Let's say in 5 years. So let's say in 10 years when you need that wealth by. Then you have to back calculate and see, to get there, what is the rate of return I need to have? Then you actually need to figure out, can I get there with about 6.5% or 7.5% after tax return? If not, then you have to now start slowly allocating it into assets which can generate higher return but may be riskier, like equities. So essentially, now if you look at today, the rate of inflation in this country is likely to be about 6% for the foreseeable future. That means that everything we buy today will be double the price in 12 years. So if your rate of return is you're going to be only 6%, that means your wealth is never going to grow. So take that into account and figure out, let's say in 10 years you need to have this amount of money either to buy a house or for your retirement or to send your children abroad for education. Calculate how much you need to put into equities, how much you need to put into fixed income, how much you may need to put into real estate in order to get that blended return, so that by the end of that time period you have the required amount of wealth. The way I see it is, most even for you to have your wealth grow by 5% in real terms over the next 10 years, you will need to have after tax return of about 11%. And you will not be able to achieve that by purely in fixed income. So do look to have that allocation into equities, real estate and other asset classes which may be risky but which might give a higher return, and mitigate that risk by becoming more investment literate. Quite simply put, saving is not investing. Saving will not make you wealthy.
Thanks, Mr. Asanka. And with that, I think we can conclude today's session. Mr. Premalal, Mr. Asanka, thank you very much for coming here to support our initiatives. So we'll wrap up today's session. Thank you.